Hey guys, it's Big Mike, and like always, I'd like to thank you for being here today. Today we welcome back FuturesTrader71 for another webinar. This time he's going to be talking about his take on the Holy Grail, Expectancy and Habits. Some of the bullet points in the webinar today will include a definition of expectancy, some historical look-backs of poor understanding of expectancy, picking a focal point for your trading, setting a reasonable and achievable goal that is also a challenge, and talking about the importance of keeping records. A business that doesn't keep records isn't a business for long. And then also a look at some of the tools that you can use that will actually make a difference. As always, the webinar is being recorded. If you're watching the recording on YouTube at a later date, please do me a favor and give us a thumbs up. It does help us. If you guys have questions, you can type them in to the questions box, and FT will let me know whenever he's ready to answer some questions, and we'll see how many of those that we can get answered today. All right, guys, with that, I am turning things over to FT. All right, you have control.
Mike, can you hear me?
I can hear you, man.
How are you?
Doing pretty good. How about you?
Not too bad. All right, let me get you to the screen.
All right, we've got it.
Okay, so you can all see that.
Yeah.
Cool. So thanks for having me on. The topic today in a series basically that we've been doing with Big Mike for how long? A year and a half now or something?
Oh, man. Longer than that, I think. Yeah, something like that.
Yeah, so this continues on the conversation. Mike probably will at some point recommend that you hit the AMA thread that's on Big Mike, and also check the archive for prior webinars to kind of build on this. So let me go over this really important topic. Before, the conversations were technical, then they became more on psychology, emotional capital, and things like that. Now I want to talk about the nitty-gritty of performance. So assuming you're on the path of kind of figuring out what you have to do to see success, we're going to move into the next space, which is how do you track success, how do you set goals and things like that. Without goals, then one of the bullets here is a ship without a rudder. It's the same concept in trading. Whoa, easy there, Tiger. So the topic is the Holy Grail of trading. Quick overview, who am I? I'm a Chicago-based professional futures trader. I started out in equities as a SOS bandit, just traded equities in and out, scalping all day in Florida. Then I started with futures and I never looked back. We can talk some other time about why I feel futures are much better for me. I'm a former owner of a proprietary trading firm. I used to basically trade for myself, and I started to back people, train fresh people who had not traded to trade company money, and I had a pretty substantial success rate doing that. And it's all about basically risk management and coaching. I'm a member of the CME group. I'm also a licensed Eurex trader, and also I'm a principal managing partner of Stage 5 Trading. As a requirement, I have to read this out, the risk disclaimer. Trading futures, options on futures, and retail off-exchange foreign currency transactions involve substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment while trading futures because of leverage. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. So we already talked about who I am. Let's take a trip to trading like a ship without a rudder. What does that mean? So I've been part of this brokerage for almost 2 years. The objective is to kind of take my prop experience and training experience and try to apply it to a much wider field globally. That's really the goal. Bring something outstanding to the world of futures trading. Based on my experience so far, these have been my personal observations. Most traders do not have a plan for how they're going to trade. They just kind of approach trading the same way they would approach a poker game or a casino. Most traders do not have any process goals set for trading. So your goals should be process-based goals, not dollar-based goals. Most people track their performance and how well they do based on how much money they're making. Most goals are dollar-based and are deceiving, because a dollar goal does not speak to the performance, your performance, and namely the execution of your plan. Making money on perfect performance, meaning excellent execution of your plan, is a whole different animal than making money by just trading. Okay, because when your performance is based on dollars, then you may end up making money and making dollars, but in a rough patch it would be very difficult for you to figure out why. I've gone through this, been trading for over 12 years professionally the whole time, full time. I've had periods of time where I'm making just relatively a lot of money, in a day, thousands of dollars in a day, and you think you've got it all figured out, and then you run into a rough patch, and there's just for weeks you have no idea what you're doing different, what you're doing wrong. That is because your goal or the way you measure your performance is dollar-based instead of a process-based goal. There's a huge difference, and it's an important point that I hope to impact you with today. Making a lot of money on poor execution or luck is not good performance. It's not sustainable performance, in my opinion. Most traders have not really come to terms with the random outcome of each trade. I mention this on every Big Mike webinar. This is another point that has to stick. Your edge is a probability over a large sample of data, whether it's back testing, hypothetical, journal, whatever. That's your edge. But the outcome of the very next trade is unknown and is unknowable. So you have to come to terms with that. And as soon as you come to terms with that, you recognize that without some sort of risk definition, without some sort of stop price, even if it's manual, you're really setting yourself up for some pain. So you have to come to terms with the random outcome of each trade. Most traders have not defined the risks to get that outcome. To get a winning trade, you have to put a loss on the line. The loss is your cost, is your fee for getting the upside, and those two go together. Waiting for the perfect trade and waiting for more information, more confirmation, and so forth causes price risk, and it actually dramatically reduces your ability to make money on your edge, whatever your edge is. So there's no way to define enough parameters to choke, a winner every time. So sitting there and waiting and waiting and waiting and waiting without some sort of a plan is a key problem. But worse than that is once you get in, you have not defined how much money you're willing to put up, how much money you're willing to lose in order to exercise that edge. That's a requirement. To me, all of these are synonymous to being the captain of a ship without a rudder or maps or a compass or crew or anything. You're basically just floating out there, randomly trading, randomly managing trades, randomly taking losses and profits. The process of trading is much more, can be much more defined than that. The outcome cannot be defined. How well you do, whether or not you'll succeed, is always up in the air. There's always a risk to trading, but you have to pin down, you have to peg down as many pieces as you can. The captain of the Titanic's poor grasp on expectancy. What is expectancy? Expectancy is best measured in ticks, not in dollars. Expectancy is basically consists of the average win, and the average win can be measured in ticks, points, dollars, whateve you want the expectancy to be. Pick a consistent unit, and it's better to not pick dollars because we have an actual psychological attachment to money. It's hard to get rid of. You were raised with it. You know, you did your chores. You got $5. We look to dollars as a reward, and we hate to lose dollars because we equate those with physical things that we can buy with it. Not good. It's hard to not do that when you're trading a stock, but in futures it's much easier because a lot of things are measured in ticks or points, and it kind of separates us from the dollar value. And also, if you measure things in ticks, then a tick is a tick is a tick, and the only thing that changes is the value of the tick. If I trade bonds, the value of the tick is much higher than the value of the tick in the S&P minis or in the Russell or in the Dow. But if I'm going after the best possible execution, the highest number of ticks per trade, then the dollars are not entering into that equation. If you don't have a choice, use dollars. But essentially, it's the average win in ticks, dollars, or whatever, times the percent of time you win over a large sample. And a large sample needs to be 30 or better, minus the average loss times the percent loss. This basically describes an average, okay? Expectancy is equal to an average. So if you've made 200 ticks on 20 trades, then your expectancy is 20. It's the same number. The difference is that with expectancy, you're breaking that average down into its two components. With expectancy, you can track the average win and the percent win, and as you build more samples, you'll find that you'll see how your percent win moves or changes as time goes by. Okay, so this means that maybe your average win is as good as it gets for your style. Maybe your average winner per trade is as far as it'll come because you're using a 333 tick chart. You like a smaller time frame. So now you have to look at your percent win and figure out what it's going to take to raise that to increase your expectancy. Whereas if you look at an average, it's not really describing anything. Expectancy simply breaks the average down, and it does so over a period of time, okay, over a large sample of trades. How is that different than just an average P&L number? Like I said, average P&L does not tell you which side of the equation needs work. Do you need to improve your targets runners, or do you need do you need better percent wins? That's what expectancy gives you. Knowing the potential return on the next trade using expectancy helps us plot and track a path to our journey, and this is what this webinar is about. It's about setting goals, creating a measurable, meaningful unit, and then setting our plans in motion using that. Knowing expectancy also gives us a goal as a focal point to shoot for and measure by the end of the week. Not knowing your expectancy is similar to the captain of the Titanic going full speed ahead without considering the potential result of that decision. For most, trading is exactly that. Go in there, get your broker to give you $500 margins, and just wing it. And there's no measurement mechanism, there's no tracking, there's no way to figure out what needs to be adjusted in order to improve your overall consistency. Picking a focal point for your trading. The one analogy I can think of for what I'm seeing day to day, now I'm using a lot of tools. I'm using this product called a trade analyzer. I can look into anybody's account and I can determine the quality of their trades. Oops, sorry. I can determine the quality of their trades and so forth. And what I'm seeing is analogous to if a rifle fires randomly. So sometimes it fires, sometimes it doesn't, and has a random scope. The scope that you're targeting with is sometimes on, sometimes off, and it has bullets that follow a random trajectory, kind of like if you've ever been paintball shooting. You know, those little paintballs, they just fly all kinds of weird trajectories. Sometimes they go straight, sometimes they turn. So if a rifle fires randomly and has a random scope with bullets that follow a random trajectory, is handed to you, and you're required to attend the Hunger Games with it as your only weapon, what are your odds of survival? Give us a guess. Come on, let's see some answers. Let's see that you're awake. What are your odds? Come on. You guys awake? Negative. I just want to make sure that everybody's here.
There we go. They had to think about it for a second.
Not good, right? That's not good. But guess what? Without following what I'm suggesting here, you are essentially in the same boat. It seems like it's an exaggeration, but really it is not. It is the same process. Sometimes you'll take that setup, sometimes you won't. Sometimes you'll scratch it, sometimes you'll take a loss. Sometimes it's a 1 lot, sometimes it's a 4 lot. That's random firing, random management, random outcomes. There's no way, in my opinion, that you can adjust that to eke out more performance. Oh, hang on, we're getting there. I'm getting dizzy looking at this thing. So what does it take to get a good focal point to measure performance? Okay, this is a really important slide. You might want to take a screenshot of this, okay? This is kind of like the homework. When somebody comes to me, one of our traders comes to me and says, hey, you know, I'm just getting beat up. I don't know what's going on. I can't, you know, get a good trade going. I basically ask them to follow this path, and this is just a piece of the puzzle, and I'm able to pull up their trades because they're trading with us. I'm able to pull up their trades. I have access to that, the trade analyzer, historical data, and so forth. But basically, this is what they have to go through. Everybody has to go through this. All of my guys used to go through this. I go through this when I have a rough spot. And essentially, as traders, the goal, the ultimate goal, is to achieve a level of intuitive trading. Our goal is to trust ourselves enough, trust our edge enough to be relaxed and loose with our trading, not with our risk. Risk is always primary, so don't mistake that to say, yeah, throw on that 20 lot and just let it rip, no stop. It's not what I'm saying. I'm saying our goal is to be mechanical enough to one day we don't have to be mechanical anymore. It's just the same as learning any skill, like driving, or using a phone, or using a keyboard. First you have to, you know, click, 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 and look at the letters on the keyboard. But if you repeat it enough, your body becomes intuitive, and then your mind is free to think about what the task is. And most traders, in my opinion, never make it there. Most traders are too caught up in the outcome of every single trade that they're actually missing the part where they're able to trust themselves to actually see the market for what it is, to be able to look at a chart and intuitively see what their bias should be and what a reasonable entry should be. So here's the process to get a focal point. In order to get a focal point, we have to determine where you are. It's a lot like going to the doctor's office and complaining that you're not feeling well. It would be imprudent for a doctor to prescribe some high-powered pain reliever, which I'm sure a lot of you would love, and send you home. What has to be done is your blood pressure has to be taken. There has to be an interview that tells what the symptoms are, that tells everybody where you are in this particular moment. And that's what this exercise is. And in order to do that, the process is not random. Now, your last doctor's visit had some sort of a form asking you, you know, does your mom have diabetes? How about your dad? Do you have any sisters that have diabetes? Do you have blood pressure? Does your dad? Does your mom? And that's It's a consistent form. These are not random questions. When a doctor's meeting with you, they're not asking random questions. They're following a process mechanically almost. And this is what we need to get to measure where you are. So, in my experience and opinion, here's what is necessary. Establish a rough edge. We're not going to talk about that right now. We're not going to talk about how you get an edge, although for most traders, this is the key to success, they think. The key to making gobs and gobs of money in trading is to have a fantastic edge that pays 100% of the time. And by the way, I have a bridge in Brooklyn that I'd like to sell you. It's a huge bridge, but I think you can buy it 30 grand. It's a deal, right? If you believe that there's an edge that guarantees wins, I'll sell you that bridge. It's an awesome deal. So this is what people are looking for. Your edge is not as important, in my opinion, it's not as important as your ability to measure it. So come up with an edge, whatever that is. Most people already have, most people who've come to us at least already have the technical skills needed or the enough knowledge of the market to actually have some sort of an edge, okay? And so let's assume you have that. It doesn't matter. It could be 51% versus 49% win-loss rate. Doesn't matter. The key here is to establish a trade management strategy. So a trade management as strategy is based on how, not why you enter the trade, but once you enter the trade, what happens. We want to remove the randomness from this part of the equation. We want to make this a steady, stable process, so your results can be measured realistically and with an anchor. So if your entries are random, meaning you're buying a pullback into some level, you're selling a fib, you're looking at some sort of GAN or geometry, you're using Renko with a moving average break, whatever that is, that's always going to be somewhat random because it occurs at the moment, and it's, each edge is not going to be exactly the same as the last one, so it is random. We can't control that part unless you're going to tell me that your trading system is fully mechanical. If your system is fully mechanical, then get out of here. You don't need this. You don't need to be listening to me. But if you're trading like almost everybody else is, your entries are somewhat random, and that is not a bad thing. That's okay. That's how I trade. Okay, it's a discretionary entry. But what we have to peg down as part of this process that I'm talking about here to create a starting focal point is you have to decide what your stop is going to be, okay, what your entry method is going to be. Are you all in, all out? Are you all in, scale out? Are you scaling in, scaling out? Or are you scaling in, all out? Pick one because you're going to be sticking with it for a while. Where will your targets be? Is your target going to be a fixed amount from your entry? Is your target going to be relative to your stop? Is your target going to be a level? Are you going to have a runner? I don't suggest a runner. If you're not consistent, don't think of runners. They're not contributing very much to your trading at the moment, at least based on the couple of dozen or so people I've looked at who use them. Is your target a reasonable distance? All of these things are not something that I can give to you because it depends on what you trade, it depends on how you trade, the time frame, the harmonic behavior of the product that you trade. It depends on a lot of those things, but it has to be something reasonable based on your experience. Okay? What is the focus with your strategy? So this is something else you want to think about. Again, this is a really important slide if you're just looking for how-to or action-based results from this talk. What is the focus with your strategy? Is your focus to maximize profits? Are you really trying to maximize profits with the way you selected your stop, your entry style, meaning all in, all out, or whatever, and your targets? Is it trying to maximize profits, meaning you are risk-seeking, really? Or are you trying to minimize risk exposure, meaning you want to scale out as soon as possible so you can bank something? Is it to maximize emotional control, meaning you will quickly close the trade? You're going for 4 ticks, you're risking 8 ticks, and it's just too stressful for you emotionally to hold on to a trade. You have to think about why you chose this strategy. It has to all fit together, and that's what a simulator is for. Commit to taking at least 30 trades using this trade management strategy. The higher the number, the more likely the edge that you come up with or the outcome is going to represent what you're going to be doing for the long term. Commit to taking at least 30 trades using this trade management strategy. Make notes on every trade to measure errors. There are 5 classes of errors. Okay? Errors are not concerned with why you entered, what happened in the market. None of that. I don't care about any of that. It does not affect the thing that you can control. Errors have to do with how you executed, because the goal with this is once you have the technical side, once you understand the emotional side, it's all about execution. This is where the rubber meets the road. The 5 errors, trade errors, are not entering when you have a signal. You're hesitating. Entering and then changing your trade management strategy. You entered, it went for you 4 ticks, it came back through you 2 ticks, and it went for you 4 ticks, and you closed it, and that's not what your plan was. Your strategy was to put it on, keep your hands off, period. Okay? I know that seems really odd, but this is what you have to do, because we're trying to remove the randomness of your emotions and your micromanagement out of this process. We want to find out if your edge is really there. Chasing a planned trade, so the market does its thing, it hits your level, you don't react because you're looking for more information, and then as I had discussed in prior webinars, the more information you get, the more price risk you take, meaning the market's moving away from your ideal point, and you go and you chase a trade that's already gone. Execution error on your platform. You go to buy, and you click the sell column. You go to buy 1, you buy 2. You go to buy, and you hit the stop button. Whatever. Those are errors, execution errors. And then impulsive trades. There is no setup. You've been sitting there all day long. Nothing has come up. You're like, it's breaking out. Let me just buy it. That's an impulsive trade. That's an error. You need to track that. And what you'll notice is when you go later to filter out your errors, the impact of those errors is going to be ridiculous. It's going to be so huge, and you're generally not aware of it now because your mind cannot keep track of how many of them there are and why. And this is why I feel that you need to keep track of them, because you need to see what they're costing you. For anybody that's done this, for any of our traders that have done this, the results were jaw-dropping. A couple hundred ticks in the Dow over 90 trades, and it's just a tremendous amount of money. If you decide to change the trade management strategy, then you must start a new sample. You got to start the 30 trades over again. This is like a new laboratory batch. You have to start the process over. This process, I'm going to tell you, is not intended for those who don't have discipline. To be able to pull this off, you have to be committed to becoming a professional trader, and you have to be committed to following the discipline required here and sticking to doing this. You can go ahead and do it in simulator and penalize yourself by a tick to make up for the quick fills or whatever. If you don't have a simulator, get in touch with me. I'll get you one. Once the series is done, the trader will have a better idea on how well the edge works. The ultimate goal, however, is to build intuition and trust in the trader that she can execute flawlessly. You have no idea what the value of that statement is. The ultimate goal, this is the Holy Grail, the ultimate goal is to build intuition and trust in the trader that he or she can execute flawlessly. If my execution is rock solid and under control, my mind and my emotions are free to see the market for what it is. There's no attachment, there's no fear, all of that. There's an indifference to the outcome of every trade. This is your goal, in my opinion. Next slide. What is a reasonable but challenging expectancy target? So once we have all of this, so let's say you go through and do the 30 trades, and now we have an expectancy. Let's say your expectancy that you came up with over these 30 trades is plus half a tick. Now we know where you are. Now we know that you're not, we shouldn't expect -3 ticks per trade or -15 ticks per trade. We know that you're at some number. Based on that number, now we can go ahead and set a reasonable but challenging expectancy target. I'll tell you the impact of this. If you know at the beginning of every week, that by the end of every week, that overall your expectancy has to be 1 tick, then what that's going to force you to do, in most cases, is to follow through with your plan, to be very focused on execution, and to not take stupid trades, not to take error trades. And because you know that a trade that was outside your plan that you got impulsive with is going to affect your expectancy quite heavily, because you're looking for a positive number of ticks per trade on average. Having a big negative number will bring your average down tremendously, because it is a negative number from a positive number. It's not a zero number, it's a negative number. So having that causes you to know where you're headed. Now you've got a rudder, now you've got a map, now you've got a compass, and now you can sail towards your port of interest, right? 3 key elements to setting an expectancy target. You have to know where you are now, which is what that prior slide is. This is what we're trying to establish here. Where are you now? You have to set a target that exceeds your best outcome now. So you have to look at your expectancy so far, look at the peak on the graph, and I'll show you what expectancy looks like on a live example from one of our traders, and pick that spot plus a little bit and make that your target for the end of the week. And until you achieve that target by the end of the week, you continue to hit that, to aim for that target until you get it. Once you get it, you increase it incrementally and on and on and on. This is like going from being a normal sit at your desk person to becoming a champion, dead weight lifter. And so you can't go out there and try to do a deadlift of 300 pounds tomorrow. It'll most likely tear out your back. What you have to do is build up, find out where you are now, and then build up. Add a few pounds on the bar, add a few pounds to build yourself to championship level. That coupled with, good eating habits, blah, 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 sleep, diet, all that, you are much better, you're much more able to achieve your target. And this is kind of the process described in the prior slide and this one. This stuff is pretty dry. It's probably pretty boring to you, but I got to tell you that with psychology and this, you're holding the 2 main keys to actually getting somewhere in this career. Okay, so you need to stay with me here. You have to commit to this target. Let's look at a real-life example. So these are trades that were downloaded by just one of our traders, one of our clients. And this trader decided to start a sample on the 20th of June of this year. Okay, and what you have here, this area right here, this is information that comes from the S5 Trade Analyzer. The S5 Trade Analyzer looks like this. So it's a piece of software that you run that's connected to the trading platform, and it tracks your performance while you're in the trade, and then it tracks your performance once you're out. So what this trader ended up with is something like this. They click on Save, and they save the file as a CSV file, which then they can import into Excel. They put into this table. Okay? Once they put it into this table, all of these statistics are being measured. And this this whole rigmarole here is being replaced with an automated online trade analyzer that does this automatically and provides some pretty detailed statistics that's going to be launched soon. And that's another key important tool. And if you have that through your broker, or if you want to get it through a software vendor or whatever, in any case, you need these statistics, okay? So this is a real-life example of a person who selected a trade management plan. His trade management plan is 2 lots. He'll trade 2 lots. So his trade management strategy is 2 lots, a 6-tick stop, 6-tick first target, and 12-tick final target. Okay, and the setups are discretionary. Taking the trade is discretionary. This person describes themselves as a momentum trader, so they're basically buying pullbacks in the direction of a larger trend. And so they started to track their performance. And you can see this column here is expectancy. It fluctuates wildly at the beginning because it's an average, but over time it stabilizes. And what we're looking for with expectancy is, even though his win percent is low, as you can see here, the average win percent so far is 39%, the average losing percent is 61%. We want to see that expectancy is dropping. Okay, so the trade management itself is religiously followed and executed, and once you execute the trade, your hands are off. You take your hands off. Okay, early on that's what he was doing, and then later he would move it 1 or 2 ticks slightly as far as his targets, based on some levels that he sees as obstacles to secure an exit. But for you, you have to make this stable. You have to make this fixed. You have to just keep your hands off the trading platform once you put it on. And then over time, the expected return is that you'll start to select better trades, more winning trades, and your expectancy will rise. So as you can see here, it's in the 30s, high 30s here on average. And as we scroll down, goes up to 42, 43, 44, 46%, 47%, 48, steady build to 50-50. 50-50, given his trade management scheme, gives him a 1.1 tick expectancy. What does that mean? That means that for every trade that this trader takes, I'm willing to bet that he's going to get about a tick return per trade. That seems like very little, but try it. It's counting all of your losses, counting all of your gains combined on an average. Being positive is a pretty good achievement. And by the way, many people start this exercise with a coin flip and retain these trade analyzer results, and the coin still beats their live results when I bring them in.
Hey,
okay?
FT.
So
just real quick, sorry to interrupt.
Yeah.
Can you clarify, should these results include slippage and commission?
You can, but it's slippage and commission, once you start getting a good expectancy, are such a small part of the equation that it's not something you need to worry about at the moment. At the moment, the thing that you have to deal with is just executing and then being disciplined enough to keep your hands off and let the trade work its way either to a stop or to a completed target. You can include your slippage and so on. By the way, these are live results, so whatever slippage, whatever execution problems there were are built into this. This is the only thing that is not included here is your costs, the exchange fees, regulatory fees, and commissions. They're not included in the tick value here, but I'm not too concerned about that. Like here, for a dollar or a 1.1 tick expectancy, essentially what this trader's pulling is about 13 bucks, something like that. 13.75, knock off $5 in commissions and costs. So overall, for this sample, the return with cost for this trader is about $8.75. You can build a career on that, believe it or not. You can actually start increasing, depending on your account size and, of course, keeping risk in mind, you can actually increase your quantity quite a bit and still manage to multiply that return. I mean, with a 10 lot, the return would be $87.50 per trade. That's a pretty substantial amount per trade. And so it's still pretty low. In general, for the ES, I'm looking for a 2 to 3 tick expectancy before I start having one of my traders increase their size. I'm looking for multiple ticks. And we have some traders that actually have achieved more than that, 4, 4.5, 5 ticks on average per trade, which is pretty good. That's a pretty good thing to build on. So let's look at this. Did you have anything else?
No, I mean, there are questions from the guys here, so you can just let me know if you want to take those, whenever you want.
Let's grab those.
Okay.
Yeah, let's grab those. Let's get some questions taken care of.
All right, so backing up here, this is a few slides ago. Thomas was saying regarding data analysis evaluation inside of Excel, he's using the platform InvestorRT, and he wants to know if you could touch on how you take a hypothesis and extract the data from the trading platform. So actually, I think that you did a webinar that covered exactly that.
Yes.
It's actually linked to it in the thread on BMT a few minutes ago. It's called Statistical Analysis for a Broader Edge. And
yes.
Anybody that wants to view that, there's several ways. You can go to BMT and go to the webinars page and just do a search for statistical analysis. That'll find it. You can go to the YouTube channel. You can go to the thread, whatever. So I think that's covered.
Yeah, that's I've covered that. I won't eat up time covering that.
Let me skip down. So people ask me about the gun example, the random example, and the random trades and such. Let me find some questions. Well, John was just asking how the expectancy number that you were showing, how can it mean anything significant if the trades are random? Yeah,
the actual trade. See, the goal here is not to. Okay, that's a fair question. The problem that I'm addressing is the fact that the biggest obstacle to people's success in this is micromanaging trades. The problem is the number of people that have decided to flat a trade, to scratch a trade, take a loss, and watch the trade go in their direction. How many times does that happen? And what we're trying to do is eliminate that, eliminate the micromanagement of a trade, and find out if that trader's edge, and I don't care if that edge is random. It doesn't matter. You can still make money on a random edge. You can make money on a coin flip, okay? And I'll be happy to prove that at some point. But it's the point is not the entry. That's not as important as sizing the trade, having a good risk reward, and execution. Not putting on a trade, most of the time what I see is people spend a whole heck of a lot of time talking about trading. They create a journal on BMT, they have a blog on Blogger, and they do the homework and are working very hard to put the message out there and make themselves accountable to their trading plan. The whole thing crumbles and falls flat on its face when it's actually time to execute it. They say, I'm going to sell this morning, I'm going to come in here and I'm going to buy 78s in the ES. I'm going to buy 78s and I'm going to target 82. And the market kind of does its thing and it walks to 78, it goes to 77.5, 76, 74, whatever, and it turns around and they sit there and they think, gosh, that came down quickly, I don't know what to do, should I buy it now, should I not? And then finally they put the trade on. If they put the trade on, most likely they won't. And then once they put the trade on, the worst part is that it goes in their direction a couple ticks, then it comes back, then it goes in the direction one tick, then it sits sideways, then it starts to go against them. It's not far enough to stop them out. Then it comes back to scratch. They scratch it. And then lo and behold, 7 times out of 10, or whatever that statistic I'm throwing out there is, the market starts kind of walking to the target. And you have this remorse. And most people with that remorse, what they do is they start selling because they missed their buy signal, they missed the homework, and they start to flip the homework on its back because they didn't take the trade because they didn't believe in it, so the opposite idea must be true. And there's just an incredible amount of conversation, anxiety, and it makes it very, very hard to enjoy being a trader. And that's because there's a tremendous amount of interference in the actual trading while it's happening. We're trying to eliminate that. We're trying to take the trader out of the equation. Once the decision's been made that you're going to attack and buy or sell, we want you out of the picture. We want the market to determine the fate of your trade, because ultimately the market determines the fate of your trade, like it or not. And so that's the whole idea behind this. I'm not trying to see if an edge exists or not. I'm trying to see if there is anything, what is its value? And by holding the execution steady, anchoring the execution, I have one piece anchored so that the other one can kind of move around, and then we can address the edge problem later. But if the execution is random, I'm going to get in at a random price and I'm going to manage this trade randomly, then you have two moving parts, and it's very difficult to figure out what to do. It's like, the old tuning the piano thing. You tighten this string, that changes that string over there. You change that string, it moves this string over here, and you're constantly going back and forth, back and forth. We're trying to anchor one side, figure out where you are, and then start working on the edge. And most people cannot make it that far, unfortunately.
FT, I have a quick question, if you don't mind. Earlier we heard the brokerage margin risk alert warning go off, and I'm just kind of curious how does that, or does it negatively impact you from like a psychological standpoint, hearing that happen every day or multiple times a day or whatever the frequency is? Is there an attachment? Being the admin of the forum, and I read all these threads and all these posts, and I see guys that struggle, and it's just kind of can weigh heavily on you after a while, and I'm just kind of curious what you're going through with that.
It doesn't impact me because, it's funny, you should ask Anthony that question. When we first started with the brokerage, I used to get really angry with what I would see on the risk screen because, I'm making a shift from being a prop owner and people trading my money to people coming in and trading their money. And to be blunt, it just pisses me off to see people trading their money stupidly, because I think they would be much better off just making a donation to a worthy cause rather than giving it to a bunch of funds or whatever, So it used to really, really bother me. It used to bother me while I'm trading, would take my focus off what I'm trying to do. However, I've done this long enough to know that, and I had a trading room with 12 people in it. And there are days when the person who makes the most money is getting pummeled, and the person who's never made money is having his best day. And you'd think there's a correlation, but it's random. It really is. There's no real specific thing that causes that. So you start to recognize that how people do is a function of so many things, because it's just such a complex process, and it doesn't affect me. I don't really care if everybody is having, if the risk alerts are going off like crazy. We have a siren for different levels and so forth. I still have to look up and see what's going on and blow people out if I have to. Don't usually have to. But it doesn't affect how I trade, because I know they're doing their thing. I know I'm doing my thing. I know I've done my thing long enough, and I know what I'm talking about, so that I just follow that plan Whereas other people, no matter what you do, no matter how much hand-holding you give them, they will still put themselves at risk. They will still gamble, and they'll still stick their necks out when they really shouldn't. So it doesn't affect me. It doesn't affect me much at all. I don't really care what someone else's view on the market is. It could be Richard Dennis. It could be Sakata. It could be any one of these big traders. And if they say the market's going to tank today and I see an opportunity to buy, I will buy it. No problem, because we're all trading different time frames.
Right, gotcha.
Okay.
Okay, getting back to some questions, and just let me know whenever you want to stop these. And I apologize for the background noise. My dog's chewing on bones.
Sure.
Brian is asking, okay, so getting back to the Excel spreadsheet and the expectancy, he says, so should he also be tracking what should have happened, like what his optimum scenario would have been if he had not made a mistake?
Ideally, yes, but let's, already it's going to be, in my experience, it's very difficult for people to get this far. But ideally, yes, you want to see what your trades did once you got out, because that's going to reinforce another idea. It's going to reinforce, it has the same effect as tracking errors, in that it helps you see what the issues really are with what you're doing. If you're getting out too early and the median trade happens to squeeze out another 4 ticks, then you need to consider maybe increasing your target by 2 ticks. But let's not get to that. The problem right now confronting everyone that I'm looking to address with this webinar is people's ability to just follow the plan. Just do what you're supposed to do. Do it so much, or do it enough to trust that you'll always do what's right. And that's the key right now. That's what's missing. The ability to execute like a professional, execute like a Marine about to break into someone's house for an inspection in Fallujah or whatever. If you don't execute it right, you could end up with a bullet,
Right.
That's how serious it has to be.
Stock trader Ben is asking, can you give some examples on what a good expectancy actually is?
A good expectancy? So think
like
of
I think you said 2 ticks, right, on the ES. But
yeah,
I mean, can
2
you?
Ticks,
yeah.
2 ticks is $25 per trade. Given all of your losses and gains and whatnot, 2 ticks is a good expectancy. Now, it's all relative because you have to put it in context. 2 ticks on Big Mike's trades, which are swing trades,
right.
is not so great,
not
right? Because you're taking tremendous risk for 2 ticks. But for a day trader holding trades, taking trades for 3-4 points at a time in the ES, 2 ticks is okay, because you're able to take more size. The way you can improve that and get a return and get an income out of it is to trade more size. Make sure everything's relative. The risk is relative to your account. Risk comes first. You trade more size and execute for ticks so that ultimately the ticks are the same. So you're going for the same number of ticks. You increase your size. That's why we don't like to track things in dollars. We don't want to see our P&L on the DOM. We don't want to see dollars anywhere. Don't care about dollars while I trade. So increase your size, and now a $25 per tick per trade return on a 20 lot really means something. And nothing has changed because the execution on the S&P is practically the same, for 3 lots as it is for 15 or 20 lots. It really is.
Mike is asking the question regarding the Stage 5 Trade Analyzer. He wants to know, is it available or does it work on sim accounts or demo accounts, or is it only for live cash trading?
No, it's available for demo. It's available for demo, and yeah, anybody who has an account, and there's I think a 2-week demo that can be extended or something. I'm not sure, you'd have to talk to a broker, but it works on demo as well as live. we want people to move from demo because your demons are going to come out when you're demoing, when you're trading live. So it's better to go live on a smaller product than to demo forever. But you can test your plan and do this exercise on the demo. But if your live plan is to have a target, let's say for this particular fellow here whose spreadsheet we're looking at, instead of having a 6-tick and a 12-tick target, when you're in demo, you're going to use a 7-tick and 13-tick target. Why? Your stop stays the same, but your target has to be increased by a tick. Why in demo? Anybody? Bueller?
There we go.
Yeah, demo gets instant fill. That's right. Like the demo is going to give you instant fill. The S5 trader, it has an algorithm to try to queue you, but it doesn't work every time. If you put in an order outside of the depth of market, where the market's actually trading, it can only assume that you're first in line. But if you put your order where there are offers or bids there, it actually tries to queue you. No matter what, you need to go and add a tick to your exits, but you don't add a tick to your stops. Why? Why don't you add a tick to your stops? Why don't you penalize your stops? Because stops are market orders. Stops are market orders. They're going to be traded practically the same in real life because it's a market order. It's already penalizing you a tick.
Right.
So that's the only difference when you're practicing.
Rex has a question. So earlier, I forget who asked. Somebody asked. He said if the setups are random, if everything's random, then how does he define an edge? And we talked about the last webinar that you did. But Rex was saying that he's watched that webinar and he doesn't remember hearing a specific answer. I guess he's talking about. Actually, I'm not sure what he's talking about. If he's talking about a specific answer and how to overcome the randomness, or if he's talking about defining an edge, because my recollection of that webinar was that you went into great detail of how to prove or define an edge. I mean, everybody has their own ideas on where to get the edge from, but defining and proving that it is actually an edge is exactly what was covered. So maybe Rex can clarify. Yeah,
well, I know what's being asked.
Okay.
In the example he gives, with the blackjack, he played blackjack and memorized it's a statistically perfect play, and knowing that the casino has a slight edge over a large number of hands. Trading is not like that because you're making decisions in trading on price movement. And the price movement is caused by human beings, and human beings can be predicted to a small extent. I can predict that if I got on the bus on the way home here in the city of Chicago and went and found the biggest guy on the bus and walked up to him and said, hey, beep, 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 and called him a bunch of names that I'm censoring out, I predict that I'm probably going to get a fist to my face. It's predictable, right? But I cannot predict how he's going to feel about that interaction hours from now or days from now. So the market has these habits, and those habits change with time. They change with context, with news, the price of crude oil, what's happening in China, what's happening in Syria. It changes all the time. Again, this does not apply to you if you're a mechanical trader and you're taking a specific edge that shows up every single time, and you're just eking out an edge over a much, much larger sample. This is for us regular traders. And for us regular traders, there is a measure of randomness because that is built into the human psyche and to human behavior. Remember, the market's driven by fear and greed. The reason the market upticks or downticks is because somebody else believes that it'll downtick even further when they sell it. They're not selling it so it can stay at that price. They think it'll go lower. And if others agree and step in, then it goes even further, and then it gets emotional, and it overshoots. And those things have their own randomness. But that's not your edge. Your edge is not as defined by many, many, many books, in my opinion. Your edge comes mainly from your ability to execute under under the conditions that you have set up, under the homework that you have studied, and so forth. It's not the same as playing a game with specific outcomes. And so look at it this way. Another way to look at it is, in poker, there are hands that you need to get to win. Those hands are defined, period. They're it's a set sample of hands. It's a flush, it's three of a kind, it's blah, 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 right? In trading, the sets of hands is infinite. So it's a very different game. Blackjack, like you said, you can encompass all the statistical possibilities and try to execute on those possibilities. In trading, the possibilities are almost infinite, and they're dependent on time, on volume, on price, on correlation, on spreads, on so many different things. And so the biggest part of your edge is your ability to execute under any condition, just like Michael Jordan's ability to score when he's being manned by two guys in the key, and he's able to maneuver. He didn't study that exact same condition before he went out in the game that night. He just intuitively believes in his ability to execute and the skill he has in order to create that edge. Trading is much more like that than it is like a game with a finite number of possibilities. And this is something that we can debate forever, but that's really the gist of it. If I can get you to execute the way you need to when the time comes, then really that's the bulk of your edge.
Okay, here's the last question, and then we can get back to the presentation. Doug has asked multiple times, actually, if you think that the days that we've seen so far in September have been more difficult than average due to the types of days that we've been seeing, or what's going on in the world. Do you think September is harder than usual, or what's your view on that?
So September so far has had 2 weeks, basically, less than 2 weeks, a week and a half. I see that it is unusual in that it's headline driven. We're not responding as expected to economic data and so forth, but overall it's been a pretty noisy summer. Since July it's been kind of wishy-washy, and it's just the way it is right now. The market's not following fundamentals. The market's generally addicted to Fed crack and is interested in tapering. It's interested in war. It's interested in in things other than earnings and the fundamental outlook in this situation of the S&P 500. It's not as interested in the performance and the fundamental outlook of the 500 stocks that make up the S&P 500.
Right.
It's just a different market, but it does not mean that there is no edge and there is no ability to make money in it. There is.
Right. And I think actually, I don't mean to read between the lines, but let's assume, perhaps incorrectly, that Doug is asking that question because he's had a bad month and he wants to know, hey, are my results bad because this is unusual? How would you help or respond to somebody that may be thinking that?
That's a difficult one to answer, and I'd have to say that it's not really related to the topic at hand, and I think we might lose people here, but maybe we can hit that some other time. But really, back to the basics.
But you got to be responsible, right? I mean, that's the first and foremost. You got to accept responsibility. It doesn't matter if it's unusual or not, right? You traded it.
Define the culprit, and the only way to define it is to have what we're talking about here. Same thing. You have to track what your performance is.
Yep.
So back to this. So we looked at a real life example, and the goal is to track this over time. Here's what looks like really a typical expectancy curve. Okay, and had this trader decided to change from trading momentum pullbacks to fibs or to moving average crossovers, what you would notice in the expectancy is that it'll experience another dip like this, like that, and then stabilize and either go flat in the negative, meaning there's no edge, or get above and then get flat because now it's time for this person to increase size, and that's the edge that they're going to have to get. With this trader, again, these are live trades that were taken since July 21st. With this trader, they've experienced their dips. They've had lapses. When I look at their trade log back here, I see that they're taking much bigger losses than they should have. And so they've had lapses, but overall, as they consistently do this every day, as they instill the habit and the power of habit, the mind starts to free itself of the noise, the execution gets quieter, and things get simpler in my experience. Just as they do when you learn to drive a car. You're not focused so much on the mirrors, you're not focused so much on the speedometers, you're actually able to tune the radio, have a conversation, and so forth. I'm sure you've been in a car with someone who's not that comfortable driving, and when they're backing out of the driveway or out of a parking spot, they'll say, "Shh, I'm backing up." And they have to put their full focus on doing that activity, and that's where a large number of people are, in my opinion. And what you want to be is that driver that just says, yeah, let's keep talking, and then you just do it almost intuitively, not even remembering how you backed out. Really, you want to get trading to a point of muscle memory with consistent execution, and that's the goal of this conversation. I'm not talking about edges versus no edge, MACDs versus stochastics or CCIs. All of those items have an edge. None of those items have an edge, depending on how you apply it. Okay, so that's really the key here. Whoa. So that brings us to the next item. A business that does not keep records isn't a business for long. And this is true for your trading business. It's true for your bakery, your donut shop, your accounting business, whatever. You need to keep track of your execution and the return in the business. So I want to ask everybody, just stick with me for a moment. How many, and honestly, nobody can see your answers except maybe Mike, I guess. How many are keeping an execution journal? An execution journal is a journal that basically has a blurb for every trade that is taken or executed. How many are keeping an execution journal? Okay, we're reaching about 20 at this point. Getting almost to 30. It's pretty good. We're past 15% of all attendees, or 10%. Okay, so some are not doing it. You need to keep an execution journal. It's important. And it could be, so the next step for this particular trader is to create a column, not worry so much about these stats, but to create a column in here called error number. Okay, you can go up here and number is 5 errors, and then just type what the error number is. Even if it's a winner, we want to know what the error is. And we want to know what's the value of those errors. How much have they cost you? Did they make you money? Did they lose you money? The next one is execution result. And that all this is going to say is executed as planned, early, stop, moved, adjusted, target. You want to keep, it's so easy to do this. And you can, I doubt that many people here are taking more than maybe 5 or 6 trades a day. So you can write this on a little post-it note and then transfer it once you save your trade analyzer results or whatever software you're using and export your fills or whatever. You can just write it out and review it once a week. And it'll take 2 to 3 weeks for you to go back and review this, for this to go, oh my God, I can't believe I keep doing the same darn thing. And it's something that we forget because our mind cannot hold on to so many details. But somehow, some way, you're going to need to figure out how to do an execution journal. How many are keeping records? Just trade records, not just printing out the statements, Not just putting the statement in a Google folder, Google Mail folder, whatever, but you're keeping records of your trades. Similar to this, you're keeping a record to what you did. What's the win rate? What is your expectancy right now? If I asked you, hey, Adam, what is your expectancy? You should know what that is. You should know what that is because it's your art. It's your lifeblood in this business. 3.56 for John. Dang. Oh, negative. Okay. How many are keeping a P&L journal? This is the most common journal out there. People are amazing at keeping P&L journals because they want to know how they're doing on a dollar-for-dollar basis. This is the least important of all journals. It's the least important. Until you're out there swinging 20, 30, 40 lots, it really isn't giving you as much bang for the buck as keeping an execution journal and keeping a record for the performance of your trades. Now, a P&L journal is better than nothing, but a P&L journal is giving you a small portion of the story. It's just giving you a dollar value of the story, and it's not giving you any context for how that dollar value was extracted. How many are keeping a statistical journal? A statistical journal. A statistical journal basically says you'd have setup, you'd have mid, IB breakout, whatever. And then what you can do then is come in here and filter for that particular setup. Okay, let me look at my mid trades, on my mid trades, and then you can sum those columns and figure out on your mid trades that got executed with no errors, so you'd filter out for no errors, what is your statistical outcome for that particular setup? If you know your setups. If you don't know your setups, you need to not be exact, but you need to have some idea of naming them. Give it an approximate name and keep track of that. And then soon you'll find that there are setups that just need to go, just need to be dropped because the risk-reward ratio on them is very poor. That's a statistical journal. Okay. In your opinion, if you could only pick one of the four, which one is the most important? Which one? Which one do you think is going to give you the most bang for your time? If you could only keep one journal, because you just have ADD and can't focus for very long. So some of you have said execution, some of you have said statistics, and some of you have said records, and one has said P&L. Statistics don't matter if your execution is random and poor. P&L does not matter if your execution is random and poor. Okay? So execution is the business that you're in. You're like a pro athlete again. Execution is all there is. Execution, despite all statistical analysis and having the probability of a trade working to the 10th decimal place, isn't going to help you if your execution is poor. All of it goes out the window. Okay? The statistical and execution journal is key. You need to know, are you executing trades as you have set out to do? Are you creating errors? And these, when you look at the overall, if you keep a statistical and a record-keeping journal and a P&L journal, overall, your execution errors are going to trump everything else, in my opinion. So keeping an execution journal is, if you can improve on execution, then the other journals will improve automatically, in my opinion. Okay? The tools that can make a difference. Let's look at the tools I created for my prop shop traders to look inside of their trades. So I'm going to show you the initial thing that I was using in my prop shop to track performance. I'm just going to go through the evolution of this process. This is the trader summary. This used to happen. I used to do this every single day. It's an export from Xtrader. the cells are populated, and then we see what the performance is. This, however, is actual. These are actual trades taken by a stage 5 client trader way back, and it's tracking this person's performance. And because I'm showing you this, regulations require me to do it in dollars and to include the cost of commissions. It's just normally we don't track dollars, we're tracking it in points. So this is the only column that would exist, and we've had to kind of change it and include the cost of commissions. In here, there's a commission of $4 round term, which is kind of low, but essentially this is how I started. I'm tracking a histogram of how many ticks gained, lost, and so forth, and the frequency. The more this graph moves to the right, the more profitable the trader is. We want the outliers to be on the right where there's positive ticks, not negative ticks. And then there's a summary table of everything, including what the point P&L is, the aggregate, the dollar amount, the overall P&L with commissions and fees, what's the max peak, what's the max size traded, what's the average duration winner, loser, longest held winner, loser, how many round turns, how many trades, what's the expectancy, $28.75 loss, so that's 2.2 ticks per trade. Profit factors less than 1, which means that there's just a tremendous amount of risk per unit of gain, and then the range taken is negative 51%. So there was around 150 points available to this trader, and they secured negative 75, so that gives them 51% negative of the range taken. The best winner is $392. The worst loser is $2,161. 38.3% win and 61.7% loss, 50-50, so they have no bias, and these are the metrics for the costs associated. This is the running total, this is their expectancy, and this is their win percent over time, and this just keeps going on, and then underneath it is just a trade log. Okay, so this is one way to journal. Another way to journal is through the trade analyzer, as we talked about, and then this thing. And again, I'm in the process of finishing work with a few others to create something that does that spreadsheet that I just showed you, but do it automatically on the web for those traders that trade through us. The other journal is a written journal, and this is a sample of a written journal. This is a comprehensive written journal, includes, state of mind, what economic releases are going to come out, and so forth, and what was done on each trade. And this is what it looks like filled in. This is a sample of a trade journal filled in. Entry was A, stops was B, so they kind of fiddled with their stop a little bit. The exit was B, so they fiddled with their exit a little bit. This was a swing trade, so on and so forth. Entries F, they chased. Stops, they didn't move. Exits, they didn't move. The overall trade is a B. I'd probably say it's a C if the entry was poor. They made a gain, but entry was poor. There's an error here, so that's how they're recording their errors. This is a quick one-page trade journal. Okay. Other methods to journal is like what Attitude Trader does on Big Mike. Big Mike gives you an excellent tool to create a memoir or a journal of your trades. And I know Attitude Trader is one of our Stage 5 clients, and he does that. And he posts it every day, and it keeps you true to what to your word. And it keeps things real, and it allows others to comment on your performance. And of course, if you put yourself out in the public, you have to have thick skin, and you have to have the ability to ignore those things that are not contributing to your overall performance. I'm sorry this is cut off, but it says a blogging a blogging website like Blogger and many other, WordPress and so forth is another way to do this. And I know a lot of people are keeping a blog on various websites. Thanks for listening. That's all I had for you today. If you want to get in touch, FuturesTrader71.com. I'm also on Twitter, twitter.com/FuturesTrader71. You can ask questions through my website. I'll try to help you. If not, then I'll send it to someone who might be able to. And that's really what I have for you.
All right. So we can open up for a few questions here before we go, and just let me know how much time you have, FT. Let's see. Harry is asking, since humans are prone to error, should he create a algo or an automated trading system?
I don't know. I can't say whether or not you should, but if you feel like you just are okay, trading is just a habit. It's a when Big Mike did his anniversary celebration, he asked me what book I would recommend, and I recommended The Power of Habit, and 10 people, I believe it was 10 people, won a signed copy of that book. And I truly believe it's about habits. It really is. And so, do you have the ability to create create a goal and then make it into a habit? If you do, then I think it's a lot less pain, unless you're an amazing programmer, it's a lot less pain than creating an automated system. I've worked with automated systems. I've worked with investment-grade automated systems. I believe the process for automated systems is just so arduous, and it requires so much upkeep and changes and retesting and all kinds of crazy stuff that I find it much easier personally to just come up with a plan and follow it. That does not mean that that's the right answer for you, but taking yourself out of the equation may sound like a good idea, but ultimately you're going to take yourself out and you're going to create a dependency on your system's parameters performing according to the market. And I find that I adapt much more easily to the market by being in it, by seeing that things are changing, by being engaged, because I find that trading systems, again, I'm speaking from not great experience, but some experience, I find that trading systems do not allow you to keep up with context, which is what's driving the market. Context is a big word, but it's really, it's really what shapes the conversation that human beings have with each other, what shapes everything that we do. And when you have a trading system is not picking up on context generally. It's just exploiting a statistical edge over time.
Right.
Okay?
If I could take a quick stab, the problem, Harry, is that if you're worried about human error, it still exists even with an automated strategy, because you have to decide, when it's running and when it isn't. You have to decide how you're back testing it, how you're forward testing it. You have to decide if it's performing the way it's supposed to be. All these things require you to do those things. And if you do them incorrectly, then there went the advantage of having an automated strategy.
It's a habit.
Stock Trader Ben asking about risk and reward. So he basically says that everybody throws that phrase around a lot, and he wants to know what the importance is of measuring risk to reward in the context of everything else that you've told us.
So, okay, so here, let me put it in the context of where I put risk reward, okay? So let's assume that, I'm doing this thing in the mornings called the Trader Bite. It's a broadcast that I'm doing. I tweet it out, and I do my homework, actually a rerun of my homework live every morning instead of tweeting all this stuff out. I'm trying to reduce the amount of typing I do. And part of that process of doing my homework is to establish the general context of the market. In my journal, and if you look back over time at my morning tweets, you'll notice that there's a much higher probability on my tweets that my primary hypothesis occurs in the market than when it doesn't. I'm not trying to show off. I'm not trying to be arrogant. I'm just telling you, and it's based on a lot of painful losing and spinning myself around and a lot of errors to get to that point. When I figure out the context of what's going to happen, okay, the next thing I have to do is answer basically a set of questions that I always have to answer that have to do with auction theory. What has the market done? What is it trying to do? How good of a job? And when I can answer those three questions, I have the key answer for a fourth question, which is, what is it more likely to do from here based on the last three? Okay, so this morning we had a gap up into a major gap zone from the 14th of August, and the expectation was for a responsive selling on the open. Okay, the target for the responsive selling was 75.50, and it did not quite get there. It stopped 5 ticks short. And so I know coming in that my primary take is to either capture the short into 75.50 or capture the long off of it. Okay, so now I've created a bias. Now I have a plan, and so my next task is to find what area or what particular thing I can lean against, what level I can lean against to take a trade. This is where risk-reward comes in. So I'm going to show you this. This is just a demo platform. Risk-reward kicks in when I decide, hey, I'm going to buy, for example, 82.50 in the S&Ps. Okay? If I'm buying 82.50 in the S&Ps, and I look at the 82.50 as an area of significance to me, which it's not right now, the last question I have to ask is, can I get my target versus my stop? Now I'm measuring risk-reward. Because if I'm sitting here and I'm going to take a trade that is not likely to get through 6 ticks, but my stop is 12 ticks away, the risk reward isn't there, because for that particular setup, I need more than a 66% win rate. Okay, I don't think I'm going to be able to get it. So risk reward fits as just one slot into a set of parameters that I'm looking for to take the trade, and these parameters occur very, very quickly. It makes it sound, it sounds like a pilot's checklist, but it's not that complicated. I know my bias for the day. I know what I want to do. Now I'm looking for a spot to do it in, because unless you're just amazing at reading where the market's going to turn every time, I have to take some risk, and in order to take risk, I need to do it against some substantial level to trade against. I look for mids, I look for IB tests, I look for the opening swing test, many different edges that you can find, okay? And so I'm looking for the market to lean against that. But if I'm taking a certain trade and my target is in an area that is not likely to get there, it is beyond some major level of resistance, confluence, and my stop is so far relative to that target, my risk reward is upside down. This particular trade has to have a very high win rate for me to even break even over a period of time. That's where risk reward comes in. Okay, so I hope that answers your question. I'm trying to be as specific as possible. I know it's a kind of a pain in the butt thing to talk about, but it's a really significant part of the process. Okay.
FT, there's actually several questions here about the brokerage. I'll see if I can combine them a little bit here. We want, I'm not going to name everybody since there's so many. Is the S5 Trade Analyzer, is the Trade Analyzer available in Excel format? Can you export it to Excel?
Yeah, that's what people do. They export the fills into Excel, and we have this sheet. We have this sheet already pre-made that you can get. You can just ask anybody in the chat room or a broker, and they'll send you this, and you can track it. This sheet was actually created by one of our traders as a community service to everyone. So this comes with it.
When will the historic Trade Analyzer be available? That's a question.
Man, It was supposed to be released a little bit ago, but it's just difficult to work with so much data. We're trying to bring in a tremendous amount of fills and so forth to keep people's historic data from April 1st going forward. It's, you know, over 250,000 lines of fills, and so we've run into a lot of issues there. But it's something that I've been working very hard to get out. It's almost there. It's almost there. I can't give you a deadline. Anybody that's worked with technology knows that it's like construction, you know, what's promised and what's delivered. The dates, there's always just a lot of slippage, and it's not in anybody's control. I can't give you a date.
What platforms does the Stage 5 Trade Analyzer work with?
Currently it works with the S5 Trader, which is through OpenECry, and you know, eventually I'd like to have it pull in our Ninja fills, because we're an independent IB, and you know, we work with various clearing firms, and we have access to pretty much any trading platform out there, including Ninja and so forth. But eventually I'd like to be able to connect it to Zenfire and Rhythmic and whatnot. But right now we just need to launch it with S5 Trader and then work on the others as we move on.
Okay. I think there's two left on the Stage 5 stuff. This guy wants to know, he says, how much are commissions?
I don't get involved in that process. I'm not into sales. I have brokers that do that. I suggest you go to, if you don't mind me giving the website.
No, go ahead.
Mike. I suggest you just swing in at Stage 5, the number 5 trading.com. I think I have it on the picture here. I'm a principal. I have a financial interest in the firm. You need to know that. But here's the website, stage5trading.com, and ask a broker for that, because pricing depends on how much activity there is, what you're looking for, and so forth. I just don't get involved in that process.
Yeah, I think the last question was somebody earlier was asking, what is the process? Is there a demo available? How do they sign up, etc.?
Yeah, you can without even getting an account, you're welcome to try out a demo. I suggest you do that. I suggest you get yourself in a position where you're really ready to take advantage of it. When you're sent the demo login, you'll have a follow-up by a broker. They're not the pestering kind of brokers, the nice guys. And they'll send you the links to get the trade analyzer. They'll send you the link to get the spreadsheet, and so on and so forth. The chat room in that environment is only available to live traders. But really, the goal here is not to sell you on a brokerage. I'm not on Big Mike to sell you on a brokerage. I'm on Big Mike to get you to trade well. Because if I can get you to trade well, you'll be around for a while, and that's good for everybody, including yourself and your family and so forth, right? So,
okay. Thanks, FT. A couple more questions if you have time. Martin wants to know how familiar you are with Van Tharp. He's done a lot of work on risk. And he's talking specifically about measuring R as a normalizing it by stop size, if you do that or not, or why you don't.
I actually, Van Tharp was one of the earliest books I read. Trading Your Way to Financial Freedom was one of the earliest books I read when I started to trade, and I'm familiar with the 1R, 2R, 3R as a measurement return to risk. I don't really use it. It's more intuitive for me, but he's very good. Van Tharp is very good at understanding the balance between risk and reward, expectancy, and so forth. A lot of my ideas that formed how I manage trades, trade management for my own trading and for my fund and so forth, are all based on a lot of Van Tharp ideas, and that's where the credit needs to go. So I'm on board with that, but I don't sit here and measure how many R's I'm getting per trade. That's not how it works.
Right. Okay. Doc is asking about the ES. He says, if you're looking for 2 points on the ES, and then do you quit for the day? He wants to know.
Okay.
I guess he's just asking, whether or not he should quit for the day. I guess is that.
That's a good one. One of the things that we're tracking as part of the historic trade analyzer is your return on per time of day. Okay, so there's a chart there that says here's what your performance has been for a certain time of the day. My answer to this is, if your execution is outstanding and you have achieved your goal for the day, and now you're moving into a period, let's say 11 Central or noon Eastern, moving forward, chances are you should probably take a walk. But if you got your 2 points on your first trade of the day, the idea here is not to get 2 points and go away. The idea here is to execute perfectly. And to execute perfectly, you need to take the next trade and the next trade and the next trade with risk in mind, having established a daily loss limit and having established how much you're going to risk per trade. So you're not going to learn much by coming in, taking one trade, and disappearing. It's just not enough trades to get you the sample sizable enough to really make an important decision on, which is, should I be trading 100 lots, given the method that I've got now that's got a positive expectancy. I don't quit when I'm up for the day, because my P&L is not some sort of chart that I trade off of. I don't stop on a 38.2% pullback of my peak P&L for the day. I'm trading the market. If the market's giving me an edge, I'm going to take it. I'm going to take it every time, and I'm going to execute it mechanically as much as possible.
Right.
So I don't believe in quitting. Now, that's separate. That advice is kind of parked to the side. If you've had 2, 3, 4 days where you've just kind of gotten pounded, then I'm going to say, hit one if you're up, go away. Hit one if you're up, go away. Because the goal then is to build your emotional confidence and to kind of put together some positive days to free your mind from all the fear. That's a different case. I don't know where you are in that spectrum, so I can't really comment. But those are the two situations.
Right. Speaking of emotions, here's a question I have for you that I get asked, or I see asked on the forum quite a lot. So FT, I don't know what kind of size you're trading, but why don't you add a zero? Why don't you add 2 zeros? What's holding you back?
Well, I have to trade relative to my account size, for one. So my risk per trade has to be within 2%, 2 to 3% on the high end when I'm adding in a zone. So that's why I don't just add a zero. And so it should be for you. Leverage is not a great thing. Leverage is great in futures when you're on a streak and so forth, if used wisely, but it's not a great thing if you're consistently imploding. So I add a zero. I add a zero when I feel that I've built up an expectancy high enough to continue to raise my size, but I'm comfortable where I am now. Also, again, not to be arrogant, but there's a point at which you just can't get filled, even in the S&Ps. It's around 120 to 150 contracts. You start to get really chopped up in your fills, but that's not really what's important. The market's a lot harder to trade now than it was 5 years ago, 7 or 8 years ago. There's a lot of headline risk, and you have to compensate for that. So, but I'm generally comfortable. I like to be on edge enough to care about the trade, but I don't like to get to the point where the emotions really rise up.
Right. That what you just said at the very end, actually, that's what has been key for me. I'm not trading 100 lots, but I am trading a lot bigger than I was a few years ago, and it's taken that amount of time for me to literally be able to put on a trade and not care. If you add a zero, you're going to care, and then you're going to screw up.
A lot. A lot, yeah.
Okay.
Everybody has an emotional threshold.
Right. All right, Brian's asking, is the key to fixing emotional issues pertaining to not taking the trade that you've identified, is it to not stay in the trade for fear of loss and not take the next trade that you've been stopped out on? He's wanting to know, does it all get solved by building confidence through tracking and growing your expectancy?
Okay. This particular issue is what this webinar is really forcefully about. You need to grab the recording once Mike posts it and read it again and follow that slide on the samples. What you have there is a personality that likes to be in control, which a lot of us are that way because of our education and so forth. And what you want is to avoid losses at any cost. You can't be in this business, in my opinion, and expect to do well without the ability to take risk. It's just, the combination does not work. You have to put yourself out there to be able to extract some sort of return from the market. And to someone like you, usually engineers, lawyers, brainy people, generally they like to control the outcome of every single thing. It's the old micromanager. And so generally your problem is going to be if you are trading with us and I could pull up your statistics on our risk system, I'll probably be able to see that you're just cutting your winners early, and you're just taking massive drawdowns and waiting for trades to come back, because you just will not take a stop. The only way out that I see that's feasible is to decide on a trade management strategy, a fixed trade management strategy that you're comfortable with, and to follow that trade management strategy for a given number of samples. 30 is a minimum, okay, 50 preferably. And what happens is it releases you from having to do that. One of the ways you could do that is, we're working with the CME, and I've been pushing the Micro FX product, which is $1.25 a tick. We have really good pricing on it. It's a product that you could trade live, do your sampling in. It's the Euro contract, which has been moving around quite a bit. I love that product. Do your sampling in it live with a fixed trade management strategy and not have it cost you $12.50 a tick plus higher commissions. But you need to do that. You need to do it live, and you need to let some trades run. The other exercise is a coin toss, and have other exercises that I recommend for that sort of problem. But it's a very common problem. You're not alone.
And Brian actually said that you nailed him to a T, that he is an engineer. And speaking of that, Andre is asking a similar question about how many MBA and higher level education graduates have you seen be successful in discretionary trading? And I'll tag on at the end of this. I've kind of found any C-level, executives really do poorly at trading because everything you just mentioned, right? They're not used to being wrong. They're used to being successful at whatever they apply themselves at, and they come in kind of gung-ho, right? That they're going to conquer this trading thing.
They've successfully done everything, and trading humbles them. And I was one of these people. I mean, I took some massive, stupid losses to recognize that, you know what, I don't know what's going to happen. And if I don't know what's going to happen, I have to be guarded with my risk, and I have to be smart with it. But you're exactly right. Now, how many of those people? We have quite a few lawyers. We have quite a few doctors. We have a lot of tech guys, like network guys, project managers, and so forth that apply, that have accounts with us. So I see a lot of the same issues and talk a lot about the same issues in our twice-a-week webinars that we have for our traders. But, all of it, in my opinion, can be overcome, because all of it is based on habit. It's all habit. It's creating a new cue, a new routine, a new reward, and following it over and over and over and over, and it just slowly goes away. The other thing is journaling your errors will, especially for the smart guys, will really open your eyes to some serious issues, that you may be ignoring. Like a lot of folks like to have runners. They want to catch a trade, get out of a little bit, for 6 ticks or whatever, and catch that 10-point runner in the ES. And so what happens is, what if you cut off all those runners? What if you just told yourself, for every runner I have, let me put in a fixed target. Let me replace that with a fixed target. The overall performance is better in what I've seen. The overall performance for those trades is better if you just take your target and go and find the next trade. Wait for the next setup and take the next trade. Things like that. You can't know that without journaling it.
Yeah. Brian also just said that the market has a way of identifying every issue you have, and that resonates very closely to me, because however long it's been, 6 years ago or so, when I quit my job and I decided to go full-time trading, I literally had to identify all these weaknesses that I had in my personality and et cetera to become successful, and I had to change them as much as I could, or if not change, at least be aware so I could avoid some of the pitfalls that I have built into me.
Yeah, you have to break it down from, to the root. So but it's so with so many things, it's so with anything that you're trying to learn. You're going to have to lose some habits and pick up some ones that reinforce you. Habits are so important. I've talked about this before, I think, on a prior webinar. Habits are so important that your personality, who you are, your ability to succeed, and even the performance in your trading, consider that the sum total result of all of your habits. Good habits can overcome rough patches, can overcome adversity, and can move you forward and get you back in line. And I think that's one area that you have to focus on, and that's why it was so important to me. And I was really actually pleased that Mike asked me to recommend a book for this for the anniversary. It's just an important thing to study. What habits are you doing every day? Which ones are serving you? Which ones are setting you back? That's just a very important thing for a trader to do, because a trader needs to figure that out, because you're in a performance-based career.
Right, and that book was called The Power of Habit, and the author is, who is it, Charles?
Charles Duhigg.
Yeah.
D-U-H-I-G-G. I posted a link for that for Gary there.
Okay, great. And I'll put that in the thread too for everybody else.
So, Mike, I don't want to cut it too short, but I've got to take care of my kids, and I need to hop home.
No, we're good. We're good. We're at the end.
This was useful to everybody. I hope you're able to take even 10% of this and kind of take it to heart and execute it. I think you'll be pleased with the results.
Absolutely. And FT, as always, I want to thank you for your time today. Thank you for putting together the presentation and for sticking around and answering everybody's questions. Guys, if you want to watch the recording again later, I'll post it probably later tonight or early tomorrow. It'll be on YouTube, or you can find it on BMT. Also, if you have questions that you did not get answered, if it's about the brokerage, it's what is it? The number 5 trading.com.
Stage 5 trading. I don't handle those questions.
And what about if they have questions for you, FT? How should they get a hold of you?
So we have that AMA thread on Big Mike, which I need to get back to and answer. The other one is to just go to FuturesTrader71.com and just hit the contact form and get a hold of me that way. It's better, though, to go on the AMA and ask a question there. That way I respond and everybody sees it. Right, exactly. All right, guys. So you can find that on BigMikeTrading.com. Just do a search, AMA, that stands for Ask Me Anything, and then FT71. And I know that we've missed the last couple of weeks due to I was sick and then I was out of the country, and we're going to get back on track on that pretty soon. So we'll be doing another one here pretty soon. All right, guys. Awesome. Thanks, FT. I'll see everybody. Thanks. Right, bye.
Bye.